What's going on, guys? I'm going to be talking about Apex Trader Funding today. This is a prop firm that has been brought up in the comment section a lot in the past few months, and the other prop firms that I've talked about. A lot of people think that this one is superior. So let's go over the rules and highlight some of the differences and then talk about it. And one of the main things I want to point out and the reasons I'm interested is they've added Tradeovate. And I know Tradeovate has had some issues of late. They said they've fixed them. I like Tradeovate and I'm a Mac user. It's much easier for me to use Tradeovate because I'm familiar with it and it works on my platform. I don't have to run parallels or anything for NinjaTrader. Whether you use NinjaTrader or Tradeovate, Apex now offers both. A good thing about Apex is they do run a lot of sales. They run pretty large sales for the lifetime of their monthly subscription. So that's a plus. I've seen a lot of sales come up in the past. And they're a bit more of an established company. They've been around a little longer. Elite Trader Funding, been kind of sketchy of late from what I'm hearing from other people and what I've seen. Big Q mark on Elite Trader Funding right now. We have to monitor them, see if they're gonna remain solvent. Typically what companies do is they have favorable rules when they launch, and then as they grow, they start to tighten the reins. And they did this in December. They made some pretty big rule changes overnight. With like the consistency rule and news trading, which is a common theme among prop firms in the market, but they've been changing things slightly, and when asked about them, they keep on pushing it back. I know some traders had delay of payments. They're still paying out traders, but it's taking a little longer. Typically, this just means perhaps maybe they're having financial issues. I don't know, I'm just speculating, but something to watch and keep an eye on with Elite Trader Funding. But let's talk about Apex and highlight some of the main themes and differences. The main one being you receive 100% of your first $25,000. I know ETF is $12,500, and then 90% after that. So the first $25,000 you make, you get to keep. Another big plus is 2 payouts per month. This is great because you can pull money out twice in a month. You don't have to trade through an entire month, and you can assume less risk. You can kind of get your bag. I always highlight and affirm the reality that you should be using prop firms to fund your own account. You should not be using them to quit your job and pay your bills. That will never happen with a prop firm. We'll talk a little bit about why later in the video, but it's just not sustainable. If you want to join a prop firm and pay off some of your rent or get a down payment for your car or pay bills or a wedding ring or whatever, cool, do it. That's what they're for. You should be learning how to trade better with a prop firm, and you should be using the money you make on a prop firm and funding your own trading account. Because if you work your job and save up $4,000 or $5,000 for 3 months or whatever it is, and you hate your boss and you spend all this time saving, and then you put it into a futures account and then you blow it in 2 days, or you lose half of it in 2 days, that's going to suck, and you're going to be pissed that you put all that time in. You should be putting that money into the market and investing and put that money to work for you. But if you trade on a prop firm, while you're getting better at trading and learning a strategy and figuring it out, you can get payouts, and then when you succeed, you can take those payouts and put it into your own account. And if you blow your own account, it's prop firm money. It's not as bad as money that you worked hard for, and you can always come back into a prop firm and refund your account. So that's the idea behind prop firms that I like to adopt. I'll take the money out and put it in my own accounts, and then I'll kind of keep trading both. So I have multiple accounts I can trade, and I'm a little more aggressive in the prop firm accounts, and then I'm a little more reserved in my own accounts, where if I make $250, I'm cool. It takes 7 days to qualify, and you can trade full-size contracts, no scaling. These are all kind of standard. No daily drawdown. They just have a trailing drawdown, and it's unrealized, and that's their big X. That's the big caveat, and we're going to talk about that one in detail. But you can trade on holidays, trade normal days, and you can trade during news. A lot of people were really pissed about the no news trading on ETF and like Topstep and those, and Topstep doesn't have that. So this is a plus for Apex. You can trade during news. No total cap, maximum payout, standard, one-step evaluation, real-time data, etc., etc. So this is all kind of standard. So the main differences are the amount you can keep, the $25,000, 2 payouts per month, and then no daily drawdowns, but you have that unrealized, and then trade during news. Those are the big ones. Like I said, they do run a lot of discounts, and then now they have the Tradeovate launch. I know they're having some issues right now at this time, but they should have it up, and they extended that discount. And once Tradeovate goes live, I'm going to get a couple accounts and mess around with it and report back. But let's talk about the rules. So they have the consistency rule, and for this one it's 30%. It's 40% on ETF, so ETF wins on that one, but it's 30% here, and then 20% flipping. Flipping is they explained it at the bottom, and this one makes sense, is basically, let's say you have to make 6,000. You make 6,000 on day one, and then for the next 9 trading days, you just trade one micro contract a day. So they want people that are going to trade consistently, not hit one big trade one micro contract a day, make $1 a day, and then pull out their money. So that one makes sense, because you're not going to do that in your real trading account. You're not going to make 5,000 on Monday and then trade $1 the next 4 days. You're going to keep trading. That one makes sense. The consistency rule, I'm not a fan of, and I'm not a fan of it because you just don't operate this way in a real trading environment. I'm not working on hitting some specific consistency rule when I'm trading options or stocks or futures in my own account. I'm just trying to win more than I lose. I want to have my winners be larger than my losers, and I want to have my winners happen more frequently than my losers happen. They don't need to be 35% consistent and 25%. That's not how real trading operates. They have this in here to protect their company because they don't want someone to come in, trade 10 contracts on CPI, make $28,000 in 4 minutes, and then request that money to be paid out. So the consistency rule is really to protect them. They try and spin it. All the prop firms try and spin it that it's to maintain a consistent winning strategy. There's no percent, all right? A consistent winning strategy is you're winning more than you're losing, all right? Doesn't matter how much. But people do come in and try and game the system. They'll have 2 different accounts, and then they go 10 lots long on CPI and then 10 lots short, and then they just blow the account that failed, and then they make all the money in the account that wins. So that's what these prop firms are trying to protect from money, and you're not going to do that in your own account. And I will say, to be fair, you're trading a prop firm to get better at trading so you can train your own account. So if you're not going to YOLO 15 or 20 lots on your own account, then don't do it on the prop firm because you're not generating any good habits. You want to be getting better at trading on prop firms, and the goal is to not have to use prop firms anymore. So keep that in mind. And that's the consistency rule. They have a whole FAQ you can go over. I'm just highlighting the main points. So the trailing threshold. Some companies have this. ETF had a version of this. I've passed those ETF accounts with the trailing, but all this pretty much means is, and this thumbnail explains it essentially, it's unrealized. So if your max loss is 2,500, you can't lose more than 2,500 or you blow the account. If you're in a trade and it goes up plus 500 and then it comes back down and you stop out at break even, you just lost $500 off your max loss because your highest balance was plus 500. So now instead of having 2,500, you really only have 2,000 of space. And the reason they have this I'm going to break it down for you. Of course, I'm going to tell you the John Watkins truth because Top J over here lives in Vegas. So when it comes to gambling and money making and edges, I've seen it all. I grew up in this environment. I know. I'm going to break it down for you. But the way they describe it is you should be monitoring your progress and monitoring your P&L. So for example, if you're up 500, you take the profit and you're not lollygagging and not paying attention. But with futures, the futures go, especially if you're trading the NASDAQ, the thing goes up 300 points, down 200 points, up 500 points, down 400 points, up 80 points, down 4. I mean, the thing goes up and down so much. It's wonky. If you're going for a larger trade, I might be up $500, but I'm looking for a breakout. I'm looking for it to go up another 30 points. Maybe it does a fake out. Fake outs happen all the time. If I get in a position and I'm up and then it fakes out and I go, oh, this thing's about to go negative, I got to get out break even. Okay, I got out break even. I assessed my risk. I prevented myself from getting into a losing trade. It went the complete other direction. But for a few seconds or a few minutes, I was up $500. Now that's chipped off of my trailing drawdown. So if you're trading these accounts, the way to do it is you have to have your take profits in it at all times. And if I was going for 1,000 and I'm up 800, I just take the 800 and keep my trailing. If I have 2,500 of space, I want to make sure I always have that 2,500. Because if I do get into a trade where I have to average into or it starts to lose, I at least have a lot of space I can manage that trade with. If I get into a trade I have to manage. But I'm always taking profit, so price is moving into my take profit, and then it never goes past that point, so I'm never chipping away from my trailing drawdown. Now, why do they really have the trailing drawdown, or the non-end of day one, is an edge. And if you go to certain firms like ETF, the end of day drawdown costs more. Why? Because As a trader, you have the advantage. Less likely chance you're going to blow your account on an end of day drawdown. So there's a higher chance that they're going to have to pay you out, and there's a higher chance that you're not going to be paying their monthly evaluation fee, so they have to charge more and collect money up front because you have the advantage. On the unrealized, they have the advantage. They have the edge. If you are familiar with the roulette table, I'll break it down real quick. They spin this thing, they put a white ball in here, whatever it lands on, you win. If you can either bet red or black, the color, so if it lands on any number that is black, you win, or any number that is red, you win. Or you can bet the individual number. And I believe it's like 36 numbers on the board. Put on 36 and you put a $1 down, you get paid 36 to 1. And then I think it's like 1 to 1 for betting black or red. So if you put it on black and it hits black and you put down $1, you win $1. Very simple, right? Now, you notice there's a green on here, and some tables have 00 green. So for example, there's 36 numbers, there's red or black. If you have 10 people at a table, because Vegas, and they know all these numbers, they've done the math. If you have 10 people at the table, and 5 bet black and 5 bet red, you're not going to make any money at the casino because you're going to pay out 5, and then you're going to collect money from 5, take that money and pay out the other 5 with it. And then if 7 bet black and 3 bet red, and black hits, now you only collect 3 winners and you have to pay out, or you collect 3 losers and you have to pay out 7 winners. So the probability of that over time is not really skewed in their favor. So they add a third color, that green 0. Tables in Vegas have 00 green. So there's a 0 and then there's a 00. So now there's really 38 on the table. So if you have 7 guys that bet black and 3 guys that bet red and it lands on green, now they pay out nobody. Now they take 100% of the winners. There's people that hedge with green too. So it's hitting black and red through 28 hands or 29 rolls. And then during that 29 rolls, everyone's hedging with some bets on the 0 green. It's not hitting. The casino's collecting all that money from the 0 green. And then on the 30th hand, it hits 0. Boom, everyone on red and black is wiped out. They collect all that money, and then the few people that hedged, or the minimal money that's on 0, they pay that one out. I remember seeing the math someplace. I think it was like the casino, it gives them like a couple percent edge. I forget. But the point is, what was a 50% chance, now the casino has a 52 or 53% chance of winning. And over a year, millions of rolls in all their casinos, this can equate to millions of dollars. This is how the casino is at an advantage in roulette because of that 00 green. That 0 and that 00 green. That's why they have that. So that's all the unrealized trailing drawdown is. It's that little bit of edge for them, because if you take, let's say you have a $2,500 max loss. Let's say you take 10 trades, and of those 10 trades, it goes up an extra $100 and then it comes back down. So you take profit at 200, the trade went up to 300 and you took profit at 200. So that takes $100 off your trailing drawdown. Over 10 trades, now you only have $1,500 of a trailing drawdown. You have less space to work with, and so you have a higher chance of failing your account. That's all that is. And if you break it down like that, the math and the probability of it, that's why they have it. They can hide behind the guise and the ruse in support of the trader's success. But the truth is, on an unrealized trailing, you got a lot of work to do. You got to be managing your risk perfectly, or you're going to chip away at that loss and blow your account, because they have the edge. All right, the prop firms have the edge, so they have these rules and they make these tweaks. This was my biggest strife with Topstep back in 2021, because they kept on changing these rules. I was in our trading group. We had like 30 of us, and they were telling everyone different things on why they wouldn't pay us. Oh, you had too many trades. You didn't have enough trades. Your trade time wasn't enough. You had to be in a trade for 20 seconds or more. That's the stupidest rule I've ever heard in my life too. You had to be in a trade for 20 seconds or more, or they would count it against you. That was Topstep. Insanity. Anyway, that was a roulette edge for them. These prop firms do this. It's, again, well, how can they do this? You don't have to buy the prop firm. You can trade your own account. So you're choosing to give them money to start their farm. This is why I remind you again, use the prop firms, understand what their rules are, and if they have these little edges working in their favor, recognize they have the edge and manage your risk accordingly, and then put it into your own account to trade. And then you don't have to deal with all these little rules. And then finally, moving on to payouts. Payouts are a lot more favorable than ETF. You're entitled to the first $25,000 that you make, and then you get 90% split through Deal. Deal is really good, and you can do a payout twice per month. This is great because you don't have to trade 20 days. You only have to trade 10 days. So you have 10 separate trading days where traders were actually placed in those 10 days. ETF is 20. Lot can happen in 10 days. Lot can happen in 20 days. I blew a couple elite accounts after day 10, in between like day 11 and day 20 last year. So again, after so many days, you're just trying to get your payout. You're not really trading like to build your account. It's so different on my, I've blown a lot of futures accounts. I haven't blown my real options account since like 2020. So it's just, you're just trading differently in a real account because you're just trading to grow it, and you grow it and you grow it and you get money and you take money out. You're not watching and, I got to trade in 8 more days and then I get money. You don't do that in your own account. If you hit a heater on CPI in your real account and you make like 4,000 in one day, boom, you just take it out, you secure that profit and go enjoy your day. This is why the prop firms, you got to just be hyper vigilant with them. But 10 days is not that bad. 10 days is good because you can't grow an account taking money out every day, right? You can't grow a personal account taking a payout every 2-3 days. You're gonna have it spaced out. So I like that you can do it 2 in a month. That's good. So, and then it's 10 active trading days from request to request. So once you make a request, if your account balances changes, it's gonna mess you up. So you make the request. You don't really want to trade the account again until you get the payout, because if you request to pull out 2,000 and then the next trading day you lose 1,000 and you don't have the funds in the account, you're not gonna get that money. So bear that in mind too. Active trading days from request to request. Each month you take your withdrawals counted as one withdrawal month. There's a minimum balance to request, and there's a maximum balance. The maximum balance you can request is this for each account. And starting the 4th month, just like ETF, there's no maximum. So again, you have to do that 3 months. Now you can take out money twice in a month, but you have to have those 10 trading days. But on the 4th month, 2 payouts in 1 month is 1 month. So by month 4, you would technically have had 6 payouts for 3 months, potentially. And then the 4th month, if you make 10K, you get to keep that whole 10K. Each account is considered separate and standalone. You have 10 accounts, you can withdraw the maximum for each account. So you can have multiple accounts. You can look into that if some people are interested in that. So those are the main differences between the main prop firms today. I'll have a link down in the description below if you want to try this out for yourself. I try and be as transparent as I can with you guys in terms of how you should approach the mentality of using prop firms. And you got to understand, a lot of these companies are coming up incessantly, it seems now. I've been getting hit up by a couple companies, and I will be making a comparison video between the major prop firms soon. I'm working on that. I'm going to do like a ranking system, and we're going to break down and find the best prop firm currently and kind of go over the main differences. Because you guys make the decision. You guys can choose whatever prop firm you want. I'm just here to bring transparency to their rules and also help you guys out in terms of how to view them with the trailing drawdown. I understand they have an edge. And the reason these companies keep coming up is because they make money. They're a business. They make money by people failing. And the few traders that don't fail get out on top, and they make that money. And the ones that don't continue to pay their program and fund it. And you're getting paid from those losers. We do have our full-time trading course in the description below if you're interested in learning how to pass these prop firms, trading strategies, mindset. Got a whole hour webinar in the course now going over what to expect. You're going to actually learn stuff in there. It's free. You can go watch it, and you don't have to pay anything, and you're going to gain tons of insight on trading. But if you need help passing prop firms or anything, Full-Time Trader is a must. If you have any questions about that, you can email me. If you have any questions about Apex or any prop firms, you can email me. Comment down in the description below what you think about Apex, other prop firms, like your general ideas. A lot of people have been talking about Apex, so I wanted to make a video highlighting them. But that's it. Keep a lookout for those comparison videos coming soon, and I will see you guys